Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how to manage concentration risk and protect your wealth. Understanding concentration risk. What investors must know in 2024. Have you ever put all your eggs in one basket? That's concentration risk in a nutshell, and it's a crucial concept in finance and investing. Imagine having too much of your money tied up in just a few assets. If they stumble, your whole investment strategy could take a hit. This issue isn't just for the big players, it's something every investor should understand. In a world where market conditions shift rapidly, managing concentration risk can mean the difference between a stable portfolio and a financial rollercoaster. Stick around to find out how you can spot it and what steps you can take to keep your investments balanced and secure. Defining concentration risk. Concentration risk is a term that may sound complex, but it's something most of us understand instinctively. It's the risk that comes from a lack of diversification, putting too much of one's financial hopes in a single area. This could happen in many forms, affecting portfolios no matter the size. Whether it's over-relying on one type of asset, a specific industry, or a geographic region, the threat looms large. If things go south, the financial impact can be significant. Types of concentration risk. Concentration risk doesn't always wear the same hat. It presents itself in various forms in the financial sector, each with its distinct characteristics. Sector concentration risk. This happens when investments are heavily focused on one industry. For instance, consider over-investing in tech stocks. If the tech market faces a downturn, the results can be devastating. The lesson? Spread your investments across multiple sectors to cushion against shocks in any single one. Geographic concentration risk. Here, risk arises from having too much exposure to a single geographic location. Let's say you invested mainly in companies from one country. Political turmoil or economic troubles in that nation could trigger significant losses. A geographically diverse portfolio reduces dependency on the fortunes of any single region. Counterparty concentration risk. This kind focuses on the risk of relying on a limited number of clients or counterparties for revenue or transactions. Imagine a business deriving the majority of its income from just a few customers. If one fails to pay up, the business could struggle. Having a broad client base helps mitigate this threat. Importance of identification. Why should we care about concentration risk? Because spotting it early can save investors and institutions from potential pitfalls. Here's why identifying it matters. Protection against volatility. By recognizing concentration risks, investors can diversify and protect themselves against unexpected market shifts. This proactive step can stabilize returns in volatile times. Enhanced risk management. Institutions that keep tabs on concentration risk can better manage their overall risk exposure. It ensures that no single risk factor can critically damage their financial state. Improved decision-making. Knowing where concentration risks lie allows investors to make more informed decisions. This informed perspective leads to strategies that optimize and secure financial health. Understanding concentration risk and actively seeking it out is like adding a safety net beneath your financial high-wire act. The aim is to ensure that adjustments can be made when necessary, keeping investments secure and resilient against unexpected disruptions. Sources of concentration risk. Concentration risk can emerge from several areas within an investment portfolio. Understanding these sources allows investors to better distribute their investments, reducing potential exposure to significant losses. Here, we'll explore some of the primary sources of concentration risk and how they can impact your financial strategy. Investment sectors. Investing heavily in specific sectors might seem attractive, especially if those industries are currently performing well. But what happens if that sector sees a downturn? Think of it like a gust of wind to a small sailboat. It can tip your financial vessel over. A portfolio heavily packed with, say, tech or energy stocks, might experience significant fluctuations if those sectors face challenges. The tech bubble burst of the early 2000s taught many investors the harsh lesson of sector concentration. Diversifying across various sectors can help dampen the impact of any negative fluctuations. Geographic concentration. Putting too much money in one geographic region poses its own set of risks. Consider an investor focused on companies solely in emerging markets. While these markets can offer high returns, they also come with political risks, currency volatility, or economic instability. It's like planting all of your seeds in a single patch susceptible to drought. Your entire crop could fail. By spreading your investments across various regions, you can mitigate the risk that any one area's downturn will have a substantial effect on your overall portfolio. Counterparty relationships. Over-relying on a small number of counterparties can introduce high levels of concentration risk. Imagine a business that primarily deals with a single supplier. If this supplier encounters financial troubles or operational issues, it can disrupt the business's entire supply chain. The same logic applies to investments. Reliance on a few counterparties can mean trouble if one defaults. To minimize this risk, it's crucial to engage with a variety of counterparties, ensuring no single entity holds too much control over your financial outcomes. Measuring concentration risk. Concentration risk might sound like a mouthful, but its implications are simple. When too much of your portfolio is tied up in a single investment or type of investment, it can spell trouble. Diversification is the key to spreading risk, but how do you measure if you're too concentrated in one area? Two tools that can help assess this are the Herfindahl-Hirschman Index and the Gini coefficient. Let's explore how they work and how they might help you keep your investment ship steady. Herfindahl-Hirschman Index, HHI. HHI is a popular metric for measuring concentration risk, often used to determine the competitiveness of markets. It's a simple mathematical formula that adds up the squares of each asset's proportion in a portfolio. The sum gives you a single number, indicating how concentrated your portfolio is. Calculation. To calculate the HHI, square the market share, as a percentage, of each investment in your portfolio and add those numbers together. If you have 10 assets, each with a 10% share, the HHI is 10 asterisk, 10 to the power of 2, equals 1000. Interpretation. The closer the HHI is to 0, the more diversified your portfolio is. A higher score means more concentration. A portfolio consisting solely of one asset would have an HHI of 10,000, 100 to the power of 2. HHI is not just for economists. Investors can use it to see if they might be too heavily invested in specific assets or sectors. Think of it like checking your car's tire pressure. Frequently assessing it can prevent a blowout. Gini coefficient. The Gini coefficient is another tool that can be applied to measure inequality, often used in income distribution studies. But you can also use it to spot concentration risk within a portfolio. It's a bit different from HHI but follows a similar logic. Concept. The Gini coefficient ranges from 0 to 1, where 0 indicates perfect equality, or diversification, and 1 represents extreme inequality, or concentration. Application. In investment terms, a Gini of 0 means all assets contribute equally to the portfolio. A Gini closer to 1 signals that one or few assets dominate your investment. The Gini coefficient is like gauging the balance in a teeter-totter. Are you leaning too heavily to one side? When you use Gini alongside HHI, you get a fuller picture of concentration in your portfolio. Both HHI and Gini coefficient provide valuable insights, making them powerful allies in your mission to manage risk. Understanding where your investments stand can guide you in creating a balanced, resilient portfolio. Recognizing concentration risk before it becomes an issue isn't just smart, it's essential for financial stability. Mitigating concentration risk. When it comes to safeguarding your investments, mitigating concentration risk is essential. Think of your portfolio as a well-balanced meal. Having too much of one ingredient can throw off the flavors. Similarly, too much investment in a single area increases the risk of financial heartburn. In this section, we'll explore strategies to diversify effectively and introduce risk assessment tools to keep your investment spread healthy and resilient. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.